Hi everyone, it's Grant Abbott speaking. Welcome. This is November the 28th, which for you and I means nothing. But when you have an American-born wife, it's a super big deal. It's their Thanksgiving, and they love making a lot of hoo-ha about it. And effectively, we've got pumpkin pie and turkey and all the trimmings. So it's going to be a fun day. We've got some other friends coming around, so better watch out. But in the meantime, I've got business to get to, and more importantly, looking at investment strategies. I also want to look at member-directed investment strategies, which are really, from my perspective, a really big opportunity for us. And I'm going to go through a few tax and common sense and practical strategies around them that we need to have a heads up on that. We're going to look at who can and when can we draft up an investment strategy for our client or not for our client. I want to look at the Tax Act, the SIS Act, and also the Corporations Act. There's quite a nice little section I found in the SIS Act as well just recently around that, but it's not for self-management, it's for larger funds. So there's quite a lot for us to get to. I also want to show you we've just put our member-directed investment strategy up on the Lightyear Docs site, so that's now available. We've got also our traditional investment strategy. So I want to go through that, just go through member directed quickly and show you the differences and give you a couple of tools for you to walk away with. Obviously, it's a pretty big issue. If we have a look at it, well, it's not a big issue, it's a huge issue. The Commissioner came out and obviously has released a number of letters. It's interesting that the Commissioner's getting what I would call quite aggressive compared to when they first took over in 1999 and were spending, I suppose, for the last 15 or so years, a lot of time in the education space. Now it's more the compliance space. Now, the reason that is obviously the tax office systems and computer systems are now giving them big data. I see that they've gone through a third of the largest funds over $40 million and really getting stuck into them. So if you've got a client that is being impacted by that or going through an audit, make sure if there's any issues or particularly around negotiations, come to us at Abbott-Family, and certainly we can help you out along that way. We've done quite a few of those. Now, he's poked his head up a couple of times, and the first one was obviously the letters that went to trustees and also auditors, which put everyone into a bit of a tailspin. Now, I know I can just tell from Lightyear Docs, I think we've had around about 2,000 investment strategies which have been completed over the last month or so, actually the last couple of months. So obviously it's a big issue for yourselves and a lot of clients. But just recently, in fact, I think it was last week, there was some good editorial that came out in relation to benchmarking. The Commissioner stating that 0 to 100% across asset classes is not an appropriate investment strategy. So for a couple of things there, if you have a look at the larger funds, particularly the retail, the industry funds, effectively benchmarking has generally been the way that they determine and really correlate their investment strategies. Actually, just while I'm here, John, really good issue there. Is anyone challenging them on the right to dictate how a fund invests? This plays into the hands of the retail and wholesale funds. John, the tax office, to my mind, at the moment, if I went back to the old 23F funds, and we're going back into the early 80s, in those days, all superannuation funds had to adopt a 30-20 rule, which was had to have at least 20% of your assets, and this was mandated and legislated. Effectively, you had to have 20% in Commonwealth government-backed bonds, and then 10% could have been in state or other bonds. So you're fairly strongly fixed interest. Now, that was legislative mandated. Here, what we have got, though, I do take up your point, John, is a good one, that the letters that did go out from the Commissioner of Taxation didn't go out to all people with assets in a single asset class over 90%, because there's actually 190,000 of those funds. So they didn't go out to there. What they did is they did pick those with LRBAs. So it does sort of put a lot of pressure on that aspect. as to, well, if you've got an LRBA, you've got to make sure that you've got the diversification, you've really got it down pat, and more importantly, that it's covered in your investment strategy. And there has to be really good, strong research as to why you're investing in property. I think that's we have moved, and the problem about it is, I've been talking with a couple other people recently, is that what we've suddenly gone from is a commissioner who really, for the first 10 or 12 years, was very hands-off, lots of education. You saw all those videos popping up on the site, and then effectively what has transpired, we then went into having a look at a lot of rulings, a lot of guidelines. Around about 2008, we had the contributions ruling, the business real property ruling, EPOA ruling, death benefits ruling. There was a whole lot of stuff there. But certainly over the last 5 or 6 years, as we've got a lot bigger, effectively there is a lot more compliance. So the commissioner, obviously there's been a changing guard for the Assistant Commissioner of Taxation Superannuation area. And so they're taking a really closer look at this particular area. So with that one, I fully agree with you, John. And I think this is one of the reasons that I set up the SMSF party, is that unless the light is shone across everyone equally, for example, surely the coaxing or the bribing of members of retail or other industry funds to join or roll over monies into Australian super to get Qantas points seems to me to be, well, I can't believe it hasn't been picked up as part of the sole purpose test. Now, that's a different regulator. The ATO looks after SMSFs and APRA looks after elsewhere, but it seems as though we haven't got a level playing field. And look, over time, I think that's going to change, but it is what it is. And unfortunately, we're suddenly going dead smack into compliance. And every week there seems to be another particular issue from the commissioner that he's looking at. I don't know if you saw recently, it looks as though he's sending out another, I think, 13,000 letters to funds that he's identified don't have their own separate bank account. So the thing about the commissioner, he's got all that data, so he's now going to start to use it. I've got another thing from Graham Davis, and it's great to see you again, Graham. Despite all the announcements of letters being issued from the ATO, is there any directive to enforce, and how would that unfold? Or is this a scare tactic? Again, the issue about it, Graham, is at the end of the day, an investment strategy has to go through the relevant criteria, which is diversification, cash flows, looking at the investment objectives, so on and so forth. And I'll look at that a little bit later on when we download the investment strategy document. But the key feature about that is that if we do breach the investment strategy, then effectively the members of the fund can recover against the trustees of the fund and their advisors and the auditor if there has been a breach. And I'll look at that very shortly. So there's not much that the commissioner can do, except obviously there's the $4,200 fine. But from my perspective is, this is a new methodology for the commissioner to go in, and by targeting auditors, he's not only just picking up the 17,700 funds that were impacted, but effectively it's put the auditors on notice to really make sure that all investment strategies are up to scratch, as we would as well. It's look, it's just we always need to abide by where the commissioner is at the moment, and if he's getting a lot more aggressive, then it's the same thing as we need to up our game. Now, the hard thing about it, and I'm sure you've probably found it as well, Graham and Ken and everyone, is that suddenly we're faced with this, and then we've got to go and tell our clients, and our clients on a scale of knowledge from 1 to 10 are probably down around about a 2 or 3. They don't even know what an investment strategy is or how to build it. And now we've got to go to them and say, okay, well, this is the new rules. And I'll say, well, why hasn't that been the case in the past? And look, it's a good opportunity. I was having a chat with Brian Wibley about this, is we've got a fairly strong investment strategy, but you can almost go to the next level and make sure that it's more like an SOA, that it does identify. But again, it's up to the client to go ahead with that. But effectively, if they don't, then they need to indemnify you. If you understand what I mean, is that if you've told them that this is the rules, the commissioner is now getting ornery in terms of enforcing investment strategies, enforcing separate bank accounts, that if the client doesn't want to pay and go ahead with advice, we can't be laissez-faire and just do free things for the client all the time. In that instance, we've got to say, look, it's going to cost this, or wrap it up into whatever package you want. But at the end of the day, you need to simply say, look, if you don't want to pay for this, or go ahead, or you've drafted up something, and look, I have seen a couple of things that trustees have drafted and have been absolutely atrocious. They're certainly not investment strategies. Then in that instance, what we need to do is they need to indemnify you. There needs to be an instance that they can't use Section 55(3) against you, because it's a very, very powerful section, as we've been finding at Abbott-Family, using it on behalf of a number of advisors' clients against nefarious people. Ken Race, are you confirming that a super fund can hold a property with LRBA with minimal other assets, e.g. cash, if there's a correctly worded investment strategy? Absolutely. So you can have, in fact, the idea around about, in fact, I remember doing my first investment strategy courses went way back in 2001. I did a whole 3-day session on investments, investment strategies, etc. In those days, there were audit guidelines from the Commissioner. Mind you, he'd only just taken over in 2009, and effectively went through and saying, look, 0 to 100% is not an investment strategy, and going through a whole lot of guidelines. They seem to have dropped off over time. But prior to that, the Insurance and Superannuation Commissioner, the ISC, which then morphed into APRA, and also the Tax Office, did have guidelines. And I must admit, I've been looking around for them, saying that it is appropriate, it can be appropriate to have 100% in one asset, including property, provided that we have coverage in terms of insurances, diversification, and it's a properly worded investment strategy. So the Commission is not saying you can't hold it. It's just simply saying you've got to work out how that fits in with diversification. But that's the same thing as, if we've got a client all in cash and they're taking a pension, effectively over time, we know that the cash flow is going to run out of that superannuation fund. And once we look at something going to run out of money, or super fund running out of potentially money, then we've got to, the auditor and also the accountant administrator needs to poke their head up and just say, look, they've got to tell their clients this is the case. Now, you're not going to tell people, well, you can't invest in cash, but just as they get older, if they're taking 6 or 7 or 8%, which is mandated minimum, and they're investing it at 1.9% term deposits, it's going to run out. They're just simply par for the course. I saw another article just recently. Now, I think you've just got to be very careful about this one, is that the trustee is making an investment strategy for the fund. We're going to be talking about member-directed investment strategies, whereby the member will make the investment strategy for just their section of that fund, their sub-fund. Now, the trustee is emboldened, or is basically, it really needs to look at the requirements under Section 52B, 2F, and also Regulation 4.09, and meet those criteria. None of those criteria that you see actually have regard to diversification of other assets sitting outside. So if you can't say, well, hold on, we're going to invest all in property because the client has got a business where he's got shareholding that's sitting in a family trust, and then they've got property themselves, they've got another property sitting over here, which is their permanent place of residence. That just doesn't work there. The responsibility is on a trustee. Can you imagine if you ran that argument and then you went to Australian Super and said, well, you've got to make up investment strategies having regard to all the other assets of every member of the fund. It just doesn't fly with the laws. The laws are essentially set into a railroad of superannuation. For example, if we have a superannuation unrelated investment trust, where, for example, Ken and I invested in, we had 50% each in, we put our SMSFs in. We're doing this, generally it's very popular with the licensing trust, that once you do that, effectively up in that unit trust, you can basically do anything you want. So you can do property development, you can borrow, whatever. It's not caught under the SIS Act. So the SIS Act just looks at what a superannuation fund can do and the broader direction of the in-house assets and what it can invest in. It doesn't have any authority or regulatory authority to go beyond that and go into the unit trust until the trustee of the unit trust of what they can invest in. There is one exception, that's 1322C, where you don't direct the trustee of the unit trust, never. It's always, well, the super fund has to be careful of that particular investment. Anyway, let's move on. So what I want to do is get a hard look. We're now coming up to Christmas, and as I said, it's Thanksgiving, and Merry Christmas for most of you. I'll be poking my head up a couple of times before that. But what happens, what if we've suddenly got these guidelines and we go back and we've done something wrong in the past, how are we going to redress that? Particularly an investment strategy, as we go on to the next slide, is a forward-looking document, looking at an investment objective and achieving that investment objective. Now, we're moving into compliance season for our client funds. Auditors are going to get a bit toey, I would have thought, around the investment strategy. Forget about the LRBA and diversification. I would have thought they'd want a good, strong, robust investment strategy for essentially all your clients. Because remember, well, I'm going to show you, they're pretty heavily at risk if they don't. Now, the main thing about that is that if we haven't got an investment strategy, because typically what most of us have done of just simply press something out of a BGL or whatever, and that pops up an investment strategy. Now, unfortunately, that's generally too late because it comes after the event. Investment strategy should really be set up in the first month of each year. And what I would do is, even if you keep the investment strategy the same, simply go through that process of ratifying the prior year one, or essentially just going through and doing it again and getting the client to ratify, getting good, strong compliance background. Because I can tell you, anyone who, if you've ever been through the law courts for any stretch of the imagination, if you don't have a document, you're stuffed because you don't have evidentiary guidelines. So it's important to go through that. So if we haven't got that, how do we cope with that? And what I want to do is I'll show you the way that I can see it is a typical good legal methodology. It's called a deed of rectification, deed of ratification. So I've built one into the light year docs. Normally, if you went to a lawyer, it's going to cost like $700-800, but I built it in. I'll show you what I've done there. What's the minimum requirement? What is a good, what's our basic investment strategy? Is it we have to do benchmarks, or we don't need to do benchmarks? Seems to me, though, that from everything I've read from the tax office since 1999, benchmarks is the way to go. And there's a danger that if we don't go down that track, then potentially we haven't got an investment strategy. And again, that's not me. It means that you're going to have to be arguing that the investment strategy is a valid investment strategy. Because if the client gets a $4,200 fine, or more importantly, can sue you for any losses, then you're in a bad position. Now, I want to look at what a good investment strategy looks like, and that's always going to, we're always going to build on top of that. The investment strategy we had about 3 months ago has been built out quite significantly since then, and will continue to do so. Who can do one legally? What is the downside for you and also your firm if you do one? And then what's the downside if you don't do one? So there's a lot of questions there, and we're going to get to them all. And feel free. A lot of you are starting to poke your head up and ask me a question. Mark, no, I haven't. We're not on your screen yet. I've just been gabbing along. So thank you for that. So when we have a look at what we've got here, we've got what is the strategy. I don't want to spend too much about that, but the Oxford Dictionary basically says that. Actually, a good question. Sorry, I'm just reading comments as well. So Ken Racer said, given ATO paranoia on SMSF, do you think all SMSFs should take out audit insurance to help cover costs of replying to any questions? Absolutely. I think that's just a given. So there's There's typically audit insurance, but there are specialist SMSF audit insurance. I know there's a couple around, so I think that's absolutely mandatory that you get that for your clients. I think the maximum limit you can get there is around about $10,000. So I'd certainly be doing that. So what is the strategy? It's a plan of action to achieve a certain goal. So the goal in the investment strategy is to meet the fund's investment objective. Now, if I had a look at a large fund, an investment objective might be that over a period of time to achieve a result of CPI plus 3%. Now, we could put that in place, so that's our objective, but I would say that that's a good objective for larger funds. But when we're dealing with our own funds or our client funds, the better investment objective, I believe, is going to be to maximise retirement incomes for all the members. And that's how we're going to invest in order to achieve that. Because if we set a goal of CPI plus 3%, and then we're investing in term deposits, then we're breaching our investment strategy is never going to meet that investment objective. And that's required at law, that the investment strategy has to have regard to the investment objective. So that if that's our investment objective and our strategy doesn't meet that, then we effectively will breach the rules. Now, as I said before, it's forward-looking. We can't look in a mirror. So have a look at the downside. I won't go into anything there, but Section 54C basically says that no person, so this is not just talking about a trustee, it's no person, which would include a lawyer, and we're sitting outside the Corps Act at the moment, so I'm just looking at the SIS Act. So no person, which include an auditor, a bank manager, in fact, we're having a fun one at the moment with a bank manager where, I'll tell you in a second what I've done, but no person, a lawyer, administrator, auditor, or whatever, can breach the governing rules of the fund. Now, the governing rules of the fund are going to include, obviously, the trustee to the fund. And my recommendation to you is, make sure that's continually updated, because if you breach, then effectively you can get caught. So it would also include, once we do a pension document, that's called LRBAs, that also fits to be forming part of the governing rules. Any document that we have and that actually looks at the maintenance and the operation of the maintenance and the operation of the fund is classified as a governing rule. So in that instance, what we've got there is, as soon as we draft up an investment strategy and it's signed off and it's accepted by the trustee of the fund, it now becomes part of the governing rules of the fund. And that means that no one can breach it. Going back and flipping it around, so for those of you who saw my SMSF will session, so that if we've got an SMSF will that says that a specific asset, such as a farm, is to be paid out to a certain child, and it must go into what we call a death benefits trust straight out of the super fund, doesn't go through the estate, and then the ongoing trustees pay it to the estate, then there's been a breach of the governing rules. So you say, well, what does that mean? Well, Section 54C says that doesn't make it invalid, so the transaction still holds. But Section 55(3) basically says that if you've breached the governing rules, that any person who has been affected by the breach effectively is in a position of recovering against damages. To show you, I just want to go through before the investment strategy how it works. I've got a friend who's having a bit of problems in terms of it's quite interesting how this works, in terms of recovering. They want to take money out on compassionate grounds because it looks as, well, the bank's given them a foreclosure notice. Now, normally what will happen there is under the SIS Act, it's regulation 619A, what it provides there is that for compassionate grounds, if you've missed out on, if a bank gives you a foreclosure notice, or I forget what the other term is, or a forced sale, then what will happen is you can then go to the trustee of the fund, and they're in a retail fund, can go to the trustee of the fund and effectively pull out 3 months of P&I or repayments, plus 12 months of interest, plus also 2 years of council rates if you haven't paid that. Now, the only fly in the ointment is, in order to do that, you've got to go to the bank and ask the bank to complete a statement which would go attached to the Commissioner of Taxation in order to get that release authority that the bank says that they've made they're either foreclosing or they're got a statutory right to claim. And the bank then has to say, well, this is what 3 months payments are from the date of that notice and 12 months interest payments. And obviously you get your council rates, etc. But my friend in that instance went to the bank and the bank said, oh, well, no, you have to pay 3 months now, otherwise we won't give you that notice, which then really means that they won't have a statutory demand there. So what we'll be doing there is we'll be issuing the bank manager. So we don't worry about the bank. You actually issue the person, because that's what 54C says. We'll issue a 54C and 55(3) notice to that person that they've effectively breached the governing rules because they will not issue that statement, because it actually sits in section 619A(3). And as a consequence of that, effectively, if they don't issue it, then an action can be taken against that person personally for loss or damages. So it's a pretty hardcore way of doing it, but it's a strict liability. For those of you who are quasi-lawyers or para-lawyers, strict liability means there's no defence of negligence or anything like that. So this is not a tort, it's actually sitting inside the federal laws. And it's a really hardcore piece. We're using this quite a lot at Abbott-Family to recover investment monies that have been lost to people where they've actually been fraudulent. So there's quite a lot of power there. Now, the problem about it when we get down to the investment strategy, I'll just go through this and I'll look at a couple of questions, is if what we believe is an investment strategy turns out not to be an investment strategy, so we don't have any benchmarks, not really an investment objective, etc., then if there's an investment outside, if there's no investment strategy, then any investment in the fund has breached the governing rules. And because the governing rules, the section 52B 2F is brought into the governing rules, it's deemed to be part of the rules. So that any loss, for example here, if a client has no investment strategy, but the administrator or the accountant or more importantly, the auditor has signed off that there is one, but we find, so the first thing is that we've got an XYZ ETF that's full in price by 20% and a $50,000 loss has been booked. Then in that instance, if someone came to me, then what I would be doing is I'd be taking an action potentially if I find that there's no if I find the document is either been dated 18 months after the end of the year and it's gone down, then I've got an action against that auditor and also the accountant or any planner in relation to that loss. So I can recover that loss as trustee or on behalf of members. And as I said, there's no contributory negligences. It doesn't matter that the trustee may have breached it also. It's any person who's been involved in the breach. So it's very, very wide ranging. So as practitioners, we need to work out, well, do we do an investment strategy or do we not? Now, if we don't do an investment strategy, then the problem about that is we have to at least tell our clients that there is an investment strategy requirement. Because if we know they're not going to do an investment strategy, then it's the same thing as that under the Commonwealth Crimes Act, we are aiding, abetting their omission of doing an investment strategy. So it backfires on us anyway. So we've got to get to a point of saying, look, we'll either do a strategy for you and we'll go through and we can rectify and ratify it by going back in time as best as possible. Or alternatively, you're out on a limb and you're giving us an indemnity. There's no grey area, unfortunately, here, particularly given the amount of legal suits there. So let me just see, I've got a couple of questions here. So from Gary Charlesworth, thank you for the question. Does the Commission have an issue in relation to substantial share trading within the fund? Is there a danger of crossing over into a business of share trading? Look, Gary, that's a really good issue. There's a couple of things that I'll just poke my head up out of that one. First off is, you can share trade in a fund. I mean, if you have a look at some of the larger superannuation funds, they do that each and every day. So they're turning over their portfolio. The very nature, if you're in an ETF anyway, that is share trading, because as the benchmarks change, there's continually reweighting of that portfolio. Now, in terms of business, there's nothing. If this is my famous one, I'll just jump out of here just to show you, and that's a really good question. So I like to make sure. So if I go through here, and I'll just poke my head up and go to Google, and I'll go ATO running a business. Super, SMSF. So if I go there, carrying on a business in an SMSF, Gary, you should have a look at this. Again, this is open to everyone, so it's been updated, but self-managed super funds are not prohibited from carrying on a business, but the business must be allowed under the trustee and operated for the sole purpose of providing retirement benefits for members. One thing I would take into account, I think that's really important, I'll look at that, is your investment strategy. The nature of the business activities and the way they are conducted must be in accordance with the fund's investment strategy. So when we have a look at that, yes, we can trade, but when we do trade, generally everything is on CGT account inside an SMSF, which is why it's much better to do property development inside a fund, because the ordinary income rules don't apply. We actually get a CGT. The one exception is if it is trading stock. So if we're continually turning over these investments, then there is an exception to the general CGT codify rule that it might be trading stock. But I would dare say the Commissioner wouldn't take that into account. The reason I would say that is that if you do treat it as trading stock, then you'd actually be able to get any losses as a deduction, which I don't think you would allow to do that. So yes, you can do share trading. The main thing that I'm poking my head up is saying, look, from that perspective, just make sure that it's covered in your investment strategy, which I'll look at shortly. So again, from John, what is the difference of totally preparing an investment strategy, invoicing accordingly, compared to assisting with or providing advice in construction of the plan in invoicing accordingly? I think the main one there, if I can have a look at it, I'll look at it when we get to the advisors, John, and I'll come back, I'll wheel round. How can a tax accountant be responsible for a loss when they are doing the books 18 months or more after the event? Also, accountants are not licensed to provide investment advice. Absolutely. But remember, we're not dealing with financial product advice. We're actually dealing here with investment strategy, which is built under the SIS Act. John, so it's important. I know it sounds weird, but effectively what happens there is, just going back to what John was saying, if we are the advisor, what I would do there is, we've got three. We've got the SISA, the Tax Act, and the Corps Act. So first and foremost, under SISA, we know the trustee has to prepare an investment strategy. Now, going along what you were saying, John, is it may be a better way of doing, if you are concerned around things, is to sit down with the client and do a fact find on them. So when we do a fact find, you'll see, if you go into our Lightyear Docs site, and this is free for everyone, so you don't need to use our investment strategy document. But if you go in and have a look here, and you can either send this out to the client and they complete it and send it back to you. So I'll just go into this, if you'll see here, the support center. We can just go in, and in the support center, you find all the webinars and training. That's where this webinar will be later this afternoon. But our strategy information advice toolkits. So we have a look at here's the Trustee Questionnaire. So this has proved popular. We've had so many downloads of this. So what we can do is we can send this to our clients, and you'll see here what will pop up is a little letter that you can obviously just send out to your clients. So you can email it out to the clients. Basically, it says the Commissioner of Taxation has released a letter to the trustees to say, amongst other things, as a trustee, blah, blah, blah. So you've probably seen this one. What you need to do, you need to cover diversification, risks. So it really goes through all the stuff around investment strategies. Now, this is where this is your words. Importantly, investment strategy, a forward-looking document, trustee must have one in place for the income year ending 30 June 2020. Please complete the following table. So again, this is something for them to complete. Domestic cash, international cash. We've given them the idea. You've got to put in, for example, 10 to 30% or this or that, or 0% if it's not applicable. So they actually start doing their own questionnaire. Now, if you then take that, John, and then complete it into the investment strategy, because this fills in straight into the or you can take the data from this and put it into the Lightyear Docs investment strategy, then effectively you're not preparing the investment strategy. Compare that to, for example, you go on to one of the software providers, and as part of the software provider, effectively what you do is you just pull off a document, tell the client this is investment strategy, or send it out with papers and get them to sign it. Then effectively you have prepared that investment strategy there for you. Now, under the Corporations Act, in fact, there's quite a nice little section. It doesn't apply to SMSFs, but applies to larger funds. So I'm just getting my book here, section 58A of the SIS Act provides, and again, it's not for SMSFs, but it's still indicative for SMSFs, that an investment strategy, which is the governing rules of the fund, can't specify specific financial products. So for that perspective, the Corporations Act deems superannuation or a member's interest in superannuation to be a financial product. Now, if the trustee of the fund invests specifically in, say, ANZ shares or Telstra or whatever, that's classified as a financial product. The investment strategy, which we're looking at, is not allowed under the SIS Act to go into specific financial products. It can go into asset allocation, but that is not a financial product. That's just simply an indicative range of the assets you're investing in. So you can prepare this and not fall foul of the Corporations Act. The Tax Act, really, there's not a huge amount in there in terms of investment strategy. It's mainly around SISA and also the Corporations Act. So have a look at that questionnaire. There's also there, I won't have time to go into it, download, there's a good letter there which you can send to your clients saying, look, we can help you with the investment strategy. And it's all a Word doc, John, so you can just simply say, this is the process that we'll do. You fill it in, add that questionnaire, send it back to us, we'll prepare it. It's going to cost, $350 or $400. Or alternatively, you do it yourself, you take responsibility, and then give us an indemnity. We talked about investment objectives before. Make sure you de-risk it. So you're seeking to maximise the income stream if they're in pension mode. So that's your objective. Remember, that's what your strategy has to be for. So make sure that whatever strategy you do, it's easy to achieve the objective. Whereas if we've got an investment objective, which is CPI plus 3%, and then we've got 100% in fixed term deposits paying 2%, then quite clearly our investment strategy breaches that investment objective. There is a defence, and I'll just pull it up here and I'll just read it to you so you can hear me just rattling through my legislation. Under section 55, I think it's 55.5, remember we looked at that, you can sue under 55.3. Under 55.5, it says it is a defence to an action for loss or damage suffered by a person as a result of the making of an investment by or on behalf of a trustee of a superannuation entity if the defendant establishes, and this could be an accountant, administrator, auditor, that the defendant has complied with all of the covenants referred to in section 52 to 53. So that would be that if there is an investment strategy and the investment is being made in line with that investment strategy, then effectively that's a defence if you go to court for any loss or damage. However, if I was going through that process, if you could show there is no investment strategy, or what's being drafted is not investment strategy, then effectively 55.5 won't apply because you can't have a defence if it doesn't apply. Now, deed of rectification, deed of ratification is a legal way, it doesn't work perfectly, of effectively saying, look, this is what we assumed, or this is what we really wanted as our investment strategy, And so what we're doing is we're fixing it up. So it's like upgrading the investment strategy and ratifying it for an earlier year. And I'll show you how that works. Now, member-directed investment strategies is where we have effectively a sub-fund. So a lot of industry funds will, in fact, I saw one the other day, CBUS, their self-managed option, enables you to invest in a range, I think, of 200 Australian stocks. So what you do is you invest in those stocks, you put in exactly what you want to invest in, and they run a sub-fund there for you. So that is a member-directed investment strategy, if that makes sense. We generally call it a wrap account. So what we're doing is we're wrapping the platform around that member's strategy. Now, we can do exactly the same inside an SMSF. There's a specific section, SIS Regulation 4.093, which empowers industry funds and also SMSFs to enable them to do these member-directed investment strategies, and also the fund's trustee, which I'll look at in a second. Now, if we've got different, as we go down to that 6-member rule and we've got different generations in the fund, if we've got pension members and the next generation coming in as younger members, which I wholeheartedly encourage, in those instances, then they've got completely different timelines. One needs cash, whereas the other one needs accumulation. They don't need cash. And it's very hard to, if you can think about it, investment strategies look at diversification, they look at cash flow needs, etc. They're two completely poles apart as to what they are. So what we can do is we can set up a member-directed investment strategy for one member, or we can set it up for all accumulation members and then set up separate ones for pension members. I'll go through and show you a little bit later on. It's more important too that if we've got, and I think this is important for you as well, Ken, is that if we've got younger members, and those younger members effectively want to get into an LRBA, it's actually the total value of the asset which is included in the fund's investments. Now, the problem about that is if I've got an LRBA with $300,000 of borrowings on it, then, and I've got pension members, then if it's not member-directed investment strategy, under the new laws, the LRBA and pension laws, effectively what happens is if we've got mum and dad are in the pension and they've got 66% of the fund and their son or daughter has only got 33%, then of that $300,000, $200,000 will actually be spread over to the T-bar side. And if they're maxed out, then they're actually going to have to commute and roll back some of their pension. So for T-bar, absolutely, we need to make sure we do member-directed investment strategies. As I said, BGL and Class easily do this. We can also switch assets between investment strategies. So, for example, if we get involved in a great investment, and then it's about to take off in the next year or two, we get wind, we get the inside tip, then we might want to move that over to the pension stage. So because once it moves over, and this has to be a book entry, so that if the underlying value of the share is $10,000, then $10,000 has to come from the pension side to do that. So it's an internal sale within the fund going from one investment strategy to another. Now, the benefit of that, of course, is that if it then takes off, it doesn't impact anyone's T-bar, but actually impacts the underlying percentage going to the pension side of the fund. And this has been done for like 30 or 40 years with life insurance companies, still goes on today, where they will transfer monies from their general insurance business or assets into their annuity business, because they always run separate investment strategies or member-directed investment strategies. And we can do the same. We can actually move assets in between tax-free and also taxable pensions. So if you can see here, it's a bit small, but essentially in both the light years docs, SMSF member sub-fund and the leading member fund, which looks after lineage and bloodline, we've got the ability to have sub-funds. And it's a bit beyond what you would find in industry funds. So in a sub-fund, you can have accumulation or of super benefits dedicated to that specific member, which is our separate member-directed investment strategy. Pay out benefits only to that member. All profits and losses are accredited just to that account. Again, BGL and Class do this. They can appoint a replacement trustee in the event of death or disability. Investment strategy and investments that may be held specifically for the member or one or more of the member's superannuation interests. So that's specifically member directed. You can put in there enduring power of attorney. You can put in there a SMSF living will and a member's will and health directive. So there's a whole lot of stuff that you can actually put into that situation. So let me just jump out of here, and what we will do is we'll actually go in and have a look at a couple of, I want to show you the investment strategy, and then what I want to do is focus in on, I think I've got one here. If I go in to my vault, I pre-prepared a couple here. So I'm just going to go into the Abbott-Family is where I put it in there. So, oh, there we go. So this is my vault. All documents go to the vault. If you haven't finished a document, you're actually going to find they're always going to be stored in my in-progress documents. So I'll go down here, and you can see here I've got member-directed investment strategy there, which I'll do a launch of. So I'll press that, and then I'll relaunch that. I've also got here, so I've done that. So that's relaunching the member-directed investment strategy. What I also want to do is, in fact, I've got it here, I think. Okay, so I've got SMSF investment strategy. Let me just go through and do this ordinarily. So to find the investment strategy, you need to simply just go investment, and you can see there, I want to do the fund strategy just to show you a couple of things around ratifications, because some of these things don't necessarily apply down to a member level. Although I will be putting them in as I'm just working out whether to include it or not. So with the investment strategy for the fund, I'll just take you through some of the important bells and whistles. So when we do, we obviously want to know what the document is. So we're doing the Smith Family Super Fund. So I've opened up the Abbott-Family Fund, but I've done the Smith Family. Now, all our documents come outside with no branding. You can put in the legal firm, which is Abbott-Family, just follow that code. Or if you're one of our licensees or you're on one of our unlimited plans, then effectively you can white label. So we can set it up, just takes a little bit of time. Unfortunately for people on pay-as-you-go, we can't go through that service because it costs us quite a bit of money to set that up. But if you're going to be a consistent user, sure, make that case to us and we'll take it from there. So what's the name of the fund? The Smith Family Super Fund. Now, what I want to do is something a bit different for you, because this is where I see the fundamental problems that we've got at the moment. So I'm setting up a investment strategy. Normally, this would be from the 1st of July 2019 to 30 June 2020. But what I've effectively got here is I've got a position of really my deed. I'll just see, let me just go through that I really need to rectify and ratify it. So I'll go and have a look. In fact, what I'll do is I'll do this from 2019 and I'll do this 2020. So I'm getting coverage for this year. So that's the current year. Now, the current investment objective is the trustee via its investment strategy seeks to maximise the fund's members' retirement benefits, including income streams and lump sums, as well as maximising any death benefits of member super. So we can either do that or we can customise it. So what we'll do there, if we customise, it goes through there. Do we want to customise? But I'm going to say no, because that's an easy one for any strategy to make. Now, do we want to rectify? Now, what we can do is we can do multiple. So the date of the rectification and ratification, we generally do it when the client comes and signs, because it's a separate deed. And as I said, ordinarily, if you went to Abbott-Family or anyone, if you're on our program, it'd be a lot cheaper. But if you went to a large firm, it's going to cost you a lot to do one of these. So let's go through the ending date of previous years. So 30, I think, yeah, 30/06 to 019. So what I've done there is I've got the ending date. I could even go back a little bit further if I wanted to. So I'll go back 2018, and then I could go 30 June 2019. So that gives me a deed of ratification. We'll put in place the trustees' details. So we've got Smith nominees, which is acting as the trustee. We've got the ACN. I'll be going for about another 10 minutes. So sorry, I'm going to go a bit over time, but please bear with me for this one. So Sydney, New South Wales, 2000. Again, you can jump off at any point in time because this will be recorded. So there's 3 directors. So I just need to put in here 3. Confirm. Then the first one is, for those of you who've been watching I tend to use the same names, the same people. I've got Sally Smith, and then I've got Matthew Smith. Now I work out, I need to put in, are they going to sign? I'm going to say, well, yes, yes, yes. Actually, what I'm going to do is I'm not going to get Matthew to sign. There's a reason for that. So we're then going to have a meeting. Again, I don't know what the meeting is, but remember, we can do this, draft it up, send it out to the client, and when they come in, we can just jump into our vault, relaunch it, and put in the date when we know they're actually coming. So we know that the meeting is going to be held at the same place, or we can actually put in your office if it's going to be held there. And the chairperson is John, sorry about that, Smithy. So we go through the next button, and now, so please enter the name of all persons interested are going to be covered. So I'm going to do 2 here. So I'm going to go John Smith, and I'm going to do Sally Smith. So John is 63, Sally is 58. Does a member have a pension? Yes. No. Pension amount, I actually am going to drop this off. So the problem is I can go back and put in prior year end, for example, 30 June 2019. But if you don't know, it's a bit superfluous. So that will drop off. Do they have insurances? No, not at all. So we then go down to our cash strategy. Now we go 0 to 30. International cash. So these are all the asset classes. Fixed interest, 0. It's better to put 0 than not applicable. Do we want to get a bit of diversification? So we might just say 0 to 20 is going to go in property, 0 for international equities. You can see these have got all the, this follows from that questionnaire. Remember the questionnaire we had? It follows exactly along those lines. Property, so let's say we've got domestic property of 50 to 70%. We go yes, so because it's more, and we've got residential property there. So again, that's 50 to 70%. We go down here, international property, none of that. An alternative strategy. Let's say that we've got, I won't do it, we can, if I wanted to, I could go 0 to 10%, and that could be, for example, in options. If I do that, then just have a look that a derivative statement would be required. So I'd click that. So just bearing in mind, I won't take you through that, but if you're doing options or anything that's a derivative, including LRBA, then you need to have a derivatives statement. So you'll click that yes button. Borrowing strategy, well, let's say we've got 30 to 50% being borrowing. Custom asset, would you like to create a custom asset? You either say yes or no. So for example, you could put in gold if you wanted, or anything, and I'll show you a bit later on. So we go through and then we end up with our investment strategy, which then gets pumped out. Now remember, you can always go back into the vault and change things as you see fit. So while it's coming up, so John Abbott, what is the difference of totally preparing? Oh, we've talked about that one, so done. Does an investment strategy have to be set for a financial year? Generally, that I would say that everything based on the SIS Act, everything is done on an income year financial year, unless you've got a different income tax return date. So yes, it generally be 1st of July to 30 June. You can, for example, set it and then ratify it into the future or go back. So when we go back and what are the asset classes, I would say effectively the asset classes that we looked at, did we get that questionnaire up there? I would say, what did I do? I was in the, if I look here, our investment, so questionnaire here, so sorry, I'll just go down. These are the asset classes that we need to look at. So domestic cash, international cash, quite often they might bleed in here, but they are quite separate, fixed interest and international fixed interest, because obviously they've got yields compared to cash. Domestic equities, international equities, domestic property, international property, alternatives and borrowing. So that's 1, 2, 3, 4, 5, 6, 7, 8, 9. Sorry, there's only 10 there. You can obviously split it. So sorry, there's only 10 there. So forgive me for saying 12. I thought there was 12, but there's only 10 asset classes that are sitting there. So please forgive me for that process. Let's go in and have a look at the investment strategy that we've produced just quickly. What I'll do is I'll put this up on the site for you as a sample. So we've got a guidance statement there, and that effectively comes through from the it's from my book, and also taking stuff out of the Commissioner's guidelines, looking at section 52B 2F. So accumulating benefits, the risk involved in making, holding and realising, the composition of the fund's investments as a whole. Now, notice it doesn't say the composition of the members' investments as a whole. Liquidity, and looking after prospective liabilities, which include pensions, and also would look after, obviously, any borrowings as well. So we then go down to the investment strategy per se. Again, I put that logo on there. If you don't put a logo in there, effectively it doesn't pop up. So it's just going to be blank, which is fine for you. So the fund objectives we've got there, the trustee via investment strategy. This must be an old one that I've done here. Sorry, this is the wrong one. So sorry about that. Let me just go in. So what did I do? So sorry about that. Oh, that's a member-directed investment strategy. Here we go. So that's the fund. Download that. So this is the Smith Family Super Fund. And oops, so we're just jumping through there. So it's a trustee meeting to accept the investment strategy. So that's okay. So we go through that one. So the trustee meets, accepts the investment strategy. And then what we do is we go into the investment strategy per se. And you can see there, sorry, I had the wrong one up, because I've got Matthew as a separate one. I've got John Smith and also Sally Smith. They're both in receipt of the pension. As I said, I'll take that out, because essentially what happens is where we've got a pension there, that payment amount will take out. We've got the objective that's basically sitting up there. We've then got the borrowing rules. We've got asset allocation there. And we've got risk that's being considered. Borrowing to invest in there. Remember, that's the figures that we actually had. I'll set this up so you can have a really good look at it. Diversification to mitigate risk. We've got holding in cash there. Because we've also gone property, the trustees decided to invest in residential properties long term. So we're covering diversification in there by reference to a research paper from the Reserve Bank of Australia. Again, Ken, you need something strong like that to cover it. Cash requirements. So we've got the cash requirements basically sitting in there. And then we go through our major asset allocation classes. And then we go into here, which is our research paper, long run trends in housing price growth. So that's basically what we've got from that perspective. What I've done in addition, you'll see here, I've done a member-directed investment strategy, which I'll just open up now and relaunch. So this is one I prepared earlier today. So remember, we had only Sally, there's 3 directors at that meeting. There was John, Sally and Matthew, who are both in pension stage. And then I've got Matthew there who didn't sign. But what I've got here is I've got, again, this is member-directed investment strategy. So I've got here Matthew Smith. Again, I'll take out that pension amount. Does he have a pension? No. So that shouldn't come up. Again, we've got that whole process. This is for a forward-looking investment strategy. In fact, if I go back to this one, sorry, not that one, this one, one of the things I forgot to show you, I apologise, is this is a deed of ratification. Remember we tick the deed of rectification, ratification? That pops up here as well. And basically what it says is that the trustee of the fund has previously created investment strategy pursuant to this for this period. An updated rectified investment strategy, which is the one following, also is part of that. And so what we're doing is we're rectifying and really overlaying this current investment strategy over the prior ones, and then the trustee is ratifying it as well. Now, it's not a perfect, obviously, but it's the best way that I can think of in order to overlay this new investment strategy. We've got our options and derivatives there as well. So let's go back to Matthew's one. So we've got Matthew Smith, age 40. He's got his own member-directed investment strategy. There's no, as you can see, that we've got a situation there. He's actually borrowing we've got borrowing for investments. These are his specific investments. We've got their domestic equities, and then we've got domestic property, residential, and then we've got, he's also has insurances as well. So that would go down. One of the things that we need to put in there, but because it's already gone into the major fund, is we've already got that research report, so we don't need to do that. But essentially then we've got a trustee meeting, we've got the Matthew, we've got all attended by all the trustees, and then what we've got here is effectively, it's only Matthew Smith. And you'll find the reason that is because that's actually embedded into our trustee, that where you've got a member-directed investment strategy, it's only the member that basically signs off. So what are the 12 asset classes? I looked at that. John Stitt, thank you for that. For a pension, you could have a question, yes or no. Yeah, I will be doing that because someone else has raised that. So rather than having pension amounts, we'll do that. So again, this is all subject to feedback. Would it be an idea of having a minute to ratify the investment strategy for each year? So it's a good question, John. If there's been no change in the investment strategy, yes, you simply have a minute saying, well, the current investment strategy is the same as last year. Or is it better just simply to go ahead and pre-prepare? Because if you already got this in our vault, then you can actually go ahead and just change go back and relaunch, change the dates, and then this will pop out again. So it's not a bad idea to, pre-prepare, but again, you can ratify it. John, do you need to do a ratification for every past year or only when the current investment strategy varies significantly from prior? What I would do is I'd go back and look at, if you think that your prior year, if your investment strategies are out of whack, yes, absolutely, got to go back. But if you believe that your investment strategy is okay for prior years, absolutely. But if you'd like to update it with a more robust one such as this, then effectively you would go down that track of doing the ratification and also the rectification. A couple of things, we'll just move to sign off. Again, all of these documents, I don't know why I've got the advice disclaimer, all the documents that we've got there, the investment strategy, the member-directed investment strategy are up and running. I am changing that pension amount as soon as we finish this. So this video will come out. I'll send out a sample for you to look at. Importantly, from that perspective, they're $49 on our platform. If you're just an LY firm, so you want unlimited documents, it's $5.95 a month. But if you want CPD and obviously advice from me, it's $7.95 a month. Or you can become a licensee, so you can do logos and all that sort of stuff. And that's $6,950 per annum. So choose where you are, but if you've had a look at our latest estate planning, which I'll show again next week, it's pretty special stuff. And so we're moving into this next level of automation and compliance. Will this investment strategy be exactly the same in 12 months' time? No, because I'm getting feedback from all of you guys, and I'd love more and more feedback. If you need my help or support, just go to Grant at ilovesmsf.com. Or support at lightyeardocs.com.au. Send us an email and we'll make. If you've got any ideas on the investment strategy, how to make it better, please, we're there to make this as best as possible. So again, we've had a look through everything. We're now in a completely different ball game with the Commissioner of Taxation. We need to make sure we've got the best of the best investment strategies, trustees, pension documentation, SMSF wills. Don't get caught up, because there are a lot of lawyers out there poking their heads around to making sure, because it's with a lot of money sitting in SMSFs, it's an easy target. Anyway, I'm off to enjoy Thanksgiving. For those of you, if I don't catch up with you before, have a great Christmas and also a wonderful year. Next year is going to be an amazing year, 2020, and particularly as we move down this track, and a lot of you are going to take that mantle on and become estate planning specialists, which really, once you go down that track, it's an amazing track to be on. Anyway, it's Grant Abbott signing off.